I hope you've already taken the time to watch the 10 to 15 minute welcome video that kind of goes through all the basics of the class, what to expect, how to submit assignments, how to submit them for me to review. That's going to be very important. That's why I even put this as the first thing in our actual lecture notes. Be sure you've gone through the welcome document, and even better, go through the welcome document with my first video. With that, let's jump right in. The first, what I'm not gonna do is I'm not gonna read through to you all of the chapter 1, what I call our text notes. This is kind of the part 1 of module 1. All of these notes, these are things that you need to know for the class, but I'm not gonna take the time and read them to you. Use these to answer a lot of your questions in the first quiz. But what we're going to go through is a little bit more difficult for a lot of students, and actually begin to look at how do we do payroll journal entries, T accounts, and how to make a payroll register. We're going to be doing journal entries, T accounts, and payroll registers every single week of this 8-week course. So we're going to start it early to get a good feel for it, and then we're going to continually use it. So you have to have this first week's material down really well to do well in the rest of the course. Okay, so the 3 things, we're going to look at the taxes. We're going to look at payroll taxes for both the employee and the employer. Note that is both of them. You may have never have known that before. You knew you had taxes taken out of your paycheck, but also that the employer has additional taxes that they have to pay that you don't even have to pay. They have to pay it out of a separate, their own fund. Now, of course, they do take it out of your check, and they are the ones that pay your taxes, but it's actually your money. They're just the middleman. But on their taxes, that is their money. It's not your money they're paying, so they're paying both yours and their own tax. So the first thing that I like to go through is exactly what are the taxes that each employee first, we'll look at the employee first, has to pay. And then I usually always like to do these in order. So you'll continually see an order like this, and it just helps you to memorize them if you always keep them in the same order. So when I talk about the payroll taxes, I'm going to almost always list them in this particular order. The first 2 being what are called Fica taxes, and we'll talk more about Fica taxes in week 2 and week 3. But Fica taxes are simply your Social Security and your Medicare tax. So Social Security and Medicare, these I expect you to memorize. When I give you a problem, I'm not going to tell you what the Social Security rate is or what the cap is. You're just supposed to know that, because it's items that don't change very much. With one caveat here, the cap does change, and we'll talk about that. But first, the Social Security percentage. Assuming you haven't hit the cap, in which most of us won't hit the cap in our normal working lives. Maybe our clients, if we're an accountant, will, if they're a doctor or a dentist or such, and they make a lot of money, they may hit the cap. Most of us won't, but we still need to know how it works. The Social Security is taxed to you at 6.2%. That's kind of a high figure, 6.2%, but that's something you will need to memorize. Social Security is taxed at 6.2%, and the cap, and we're going to use the cap for this class even into 2020. We're going to still use the 2019. I do the videos every other year. I remake these videos. So for 2019 and 2020 years, we will be using this cap for Social Security, possibly even into 2021, but we'll see. All right, so $132,900. Once you have made that much money in a year, you are no longer taxed for Social Security. So it's kind of a simple, a little bit of a break for the rich. Could be a huge break if you make millions of dollars. You only pay tax on the first $132,000. But for most of us, we pay tax on all of our wages all year long because we don't hit that cap of $132,900. We're going to see how that works when we get into week 2 and week 3. Especially next week in week 2, we're going to see more of how that works. Most of the items we do today won't hit the cap, but we will look at that in the future weeks. Medicare, your second FICA tax. So FICA taxes, what that stands for is Federal Income Contributions Act. And Social Security is the first one. Your Medicare is your second one. Medicare, you're going to need to memorize this, is at 1.45% is the amount that you pay for Medicare, and you pay that no matter how much you make. There is no cap. One caveat, once you make over about $290,000, now it kind of depends on if you're married or not, but that's a rough range for you. If you make that much, then you actually pay a little bit more in Medicare tax, an extra 0.9%. We'll get into that just briefly more in the next couple of weeks as well, but we won't dwell on that aspect since that's a pretty high dollar figure. The third tax that employees have to pay is your federal income tax, and a lot of times I'll call this your federal withholdings. That's what the Fed WH stands for. And how much is taken out of your check all depends on your marital status and how many allowances you claim. And allowances are things like if you have kids and any other dependents that live with you. We're going to get into this a lot more in week 4. So for now, when we do journal entries, I'll simply just give you a percentage. I'll say 10% or 6 or 5% of the wages are taxed for federal until we get to week 4 and we look at those in particular detail of how to get it exactly right. The final 2 items are the state or the local based. Your state tax, you will need to memorize how much that is. That one doesn't change for Indiana. That's 3.23%. Or I shouldn't say it doesn't change. It changes very rarely. It may fluctuate within a 1/10 or 2%, but not much. We're going to look at that more coming in week 4 and 5, as well as the county taxes. County taxes are based on where you actually live, so it's different per county. I will always be giving that to you, therefore, in class. Now, so a whole journal entry is going to cover all 5 of these taxes, and we're going to look through that. We're going to do that in a few minutes. But first, let's look at, we've now looked at the employee side of the taxes. Now let's look at the employer side of the taxes. The employer pays 4 taxes. Whatever Social Security you come up with for the employee that they have to pay, the employer has to kick in an additional amount of the exact same amount. So if the employee kicks in $12, the employer has to kick in an additional $12. So therefore, $24 is being paid to the Social Security fund. The same for Medicare. The employer kicks in the exact same amount that the employee had to pay and take out of their paycheck. So the first 2 are very easy. Once you've calculated the employer is the same. It's just extra money going into that fund. The final 2 are, for Indiana purposes, only paid by the employer, and that is the Fica tax. We're going to talk a lot more about this when we get into week 6, but just real briefly, the Fica is an unemployment tax. It stands for Federal Unemployment Tax Act. So the federal side, it's a very low amount, only 0.6%, or as a decimal, 0.006. And note the wages, they're capped at a very low amount as well. So lots of people will hit this cap and you don't pay wages on everything you make, or the employer doesn't pay tax on everything you make. Only the first $7,000 every year. For the state, for the SUTA tax, that's also in Indiana an employer-only tax. That will vary depending on the employer, and therefore I will have to give it to you what the percentage is. For the Fica rate, it doesn't vary. It's always 0.6. However, for the SUTA, it does vary per company, and I will give that to you. However, the cap does not change. So the cap for Fica was $7,000, and then for Indiana, the cap is the first $9,500 you make. You'll be taxed at whatever rate for that company. You can have some other withholdings as well when you're doing a journal entry and taking money out of the paycheck of your employee. And so I just listed a few, like your medical insurance premiums, or if you put money into a retirement plan, the employer is going to withhold money out of your paycheck and put it into a certain fund. If you put money into your flexible spending account or an HSA account, That money is taken out of your check and putting into a different fund and T account. And then some other ones that are not so nice, like garnishments. Maybe it's child support you have to owe. Okay, just a real quick review. Most who will be taking this class have had Accounting 101, and it is really helpful if you have. But I'm going to take just the next 5 minutes or so and briefly go through a journal entries and T accounts, and then we're going to do an example of a payroll journal entry and see how it actually looks. All right, so when you look at T accounts, I've got them pulled up here. There's 5 main parent accounts in accounting: the assets, liabilities, owner's equity, revenue, and expenses. The main ones we're going to look at just for this class are the liabilities and the expenses. And then we'll briefly use cash to pay our employees as an asset. And so this is one of the attachments you have available in our week 1. I've made a real generic payroll type T account, and I left a few of the common Accounting 101 ones just to give an example. But we're not going to use sales revenue in this class. We're not going to use common stock really, but we will use cash and then all of these different liability accounts. So it's all under our liabilities. We're going to have debit and credit amounts. And then with our expenses, we're going to have a few expenses. The 2 primary ones here are our first 2 are wages and payroll tax expense. And then if the employee has any other, the employer matches or pays for anything else for the employee, they may incur some other expenses as well. So these T accounts are always from the employer's standpoint. Whenever they take money out of the employee's paycheck, they have to put it over here and say that I'm going to be paying it later as a payable. So, okay, when we now can kind of talk about the debit and credit and what I mean by the nose. So the debit, if I ever say debit in this class, that simply always means the left side of the T account. Credit always means the right side of the T account. It does not mean plus or minus. As you can see here in an asset, on the left side is the debit, and it is a plus. But when you get to the liabilities, the left side, the debit, is a minus. So debit and credit can be either. It can be plus or minus. It just depends. So the easiest way to remember is debit just means left, and credit means the right side of the T account. When we do a journal entry, key items to remember: debits always go first when we list our journal entries, and credits are always indented and they go second. So if we have more than one debit, we're going to put all the debits first, all right along the left-hand column, and then second we put in our credits and put them indented, just like you would a paragraph, a new paragraph. You indent it slightly over to the right. And then every time we do a journal entry, we're going to update our T accounts so we can keep a running total of how much wages we've paid, perhaps, how much Social Security tax we owe to the government. We're going to keep track of all of these and then add them up when it's time to pay the bill to see how much we owe. And then when we pay it off, we're going to reduce our liability. So just for a quick example, if I take $10 out of my employee's paycheck, I'm going to put $10 over here on the credit side because that's a plus. I owe 10 positive dollars. You can't owe 10 negative dollars for your very first entry. That's not practical. You can't have a negative 10 starting balance. You can easily have a $10 plus balance. And then if you would pay it off, that's when your liability goes down. So if you have 10 positive dollars that you owe, and then you pay it, you're subtracting 10, then you owe nothing. So your balance here would be a 0 on the plus side of that particular account. Okay. So I have this out there for you to use if you so wish. But now we're going to begin to look at an example. Oh, I should say the last thing, as we do journal entries, we're always going to have 2 journal entries. The employee has a journal entry that shows how much taxes are taken out of their check, and then finally how much we pay them. And the second journal entry is actually the employer's additional taxes that they have to pay. Remember those 4, the Social Security and Medicare, that are the exact same, and then the FUTA and SUTA, those are all the taxes that they owe. All right, so let's look at how these journal entries actually work, and then we're going to do a practice one. So my example here says on March 15th, my employee had previously earned $6,700. This paycheck, we have netted, or not netted, but we grossed another $1,000 in earnings. So our SUTA rate is 4%. I have to give you some of these, otherwise you wouldn't be able to know them. So I'm going to always give you the items that fluctuate per company. You're going to need to memorize the items that I have told you up above that you need to memorize. So I'm going to give you the SUTA rate, and for now I'm going to give you the federal rate because we haven't discussed how to actually get that yet. Indiana rate, I do expect you to know that, and then the county rate will always be different, so I will always give you that as well. And then to help our T accounts work out, I tell us in this problem that we're going to assume an opening balance for capital and cash of $5,000 each. That'll keep the accounting equation equal. So when I go into, let's go into my example. All right, journal entry number 1 here. I've got $5,000 in my cash to start, and that's on the plus side. And then I've got $5,000 in my common stock, also on the plus side. So that's my starting balances. That just gives me a little bit of money to pay my employees as we get ready to pay them. Now we're ready for the journal entry. I need to show that the employee has earned another $1,000. And then I need to know this because if I've hit any caps. All right, so let's go through it and see what we got. First thing, wage expense. That's always our debit. How much did the employee make? So we're going to come over here to our wage expense, and everything in orange, that's for this first journal entry. So we've got $1,000 in our wage expense. That's up on the plus side. Your first, whenever you're doing T accounts, your first entry should always be to the plus side. After that, they may go into the negative sometimes, not always. But for example, definitely with cash, you're going to pay cash, so that's going to be a negative sometimes. Or you're going to pay off your liability, so that's going to be a negative sometimes. So our first entry is just how much did the employee make. Then our next 5 are these 5 items. We're going to list these 5 and see how much does the employee owe in the taxes that they have. So the first one, we're always going to do them in order too. So the first one is the Social Security. This employee was nowhere near the cap, up over that $132,900 mark. They only made $6,700 so far. So they're taxed on everything at the full 6.2%. So we just simply take 1,000 times 6.2%. And then that is how much is taken out of the employee paycheck. And that's how much the employer will then owe coming up to the government. So that's why I put the 62 here as my first credit. The employer owes a positive $62. Next is our Medicare. And notice the credits here, I have them indented. I have my debit out here to the left, and then all of my credits are indented and come second. Medicare, 1.45%, no cap ever. So we tax the full 1,000 on that. Federal withholdings don't have a cap either. So we're going to tax, I tell you how much the federal is, 5%. So we're going to take the full 1,000 times 5%. So that's $50. And then our last 2, the state and county. Remember the state, I expect you to memorize that. That's 3.23%. And there's no cap, so the full 1,000 at that percentage. And then finally, our county rate. I do tell you that because that depends on exactly which county you live in within the state of Indiana. And 2% of 1,000, $20. We're almost done with this first entry, the first of the 2 entries. We've got how much the employee made. We've got all of the deductions that are taken out of their check. And we can start seeing these now. I'm going to pull these up. So I've got my Medicare, 14.45. Ignore the different colors for just a few minutes. We're going to get to those. The federal income tax. I got the state income tax and the county income tax. All of those that I just did here. Now we're ready to pay the employee. We simply need to write them a check for whatever's left. So all we need to do is take 1,000 and then subtract out all of these withholdings. And you should come to a final cash credit that you're actually writing a check to your employee for the $821.20. And we're going to put that over here into our cash T account, the orange item, $821.20. So now if I would want to know what my cash balance is, I could simply take 5,000 minus the $821.20. And I can figure out how much cash I have in our checking account. Now we're ready for part 2 of the journal entry. Part 2 is simply the employer's taxes that they have to pay in addition to what the employee just paid. So when we talk about the employer taxes, the first thing is our debit. Before, our debit was wage expense. We knew exactly how much it was. That's how much the employee earned. When we're doing the second one here, how much the employer has to pay taxes, I actually don't know what that is until I add up all 4 taxes. So this one at first would actually be blank. You don't know that it's 118.30. I've already got the answers pulled up, sure, but for right now, we would have a question mark here. We don't know what that is. We're going to know it once we filled out these 4 taxes and put in the dollar amounts that are due. So Social Security and Medicare, remember those 2 were the exact same as the employee. So I can just copy these 2 amounts down. And then I come over to my T accounts and I do the same thing. Social Security and anything you see in blue, this is our second journal entry. So I had $62 extra coming out of the employer's pocket and $14.50 coming out of the employer's pocket for Medicare. Now, the Fica tax. This is the one where it's just a little bit tricky, and why I had to tell you this piece, how much previous earnings. If I would add up 6,700 plus 1,000, I would have $7,700 in earnings. That is over, if you remember, that is over the cap. For Fica purposes, our cap is 7,000. 6,700 plus 1,000, that's too much. That takes me over the cap. So I don't want to tax all $1,000 that this person earned. I want to only tax the last 300 that got me to 7,000. And I'll show you the 2 steps that you can work that will always help you if you can't quite see that real quick. What you want to do is step 1 is figure out, did you go over the cap? If you're close, just do the simple adding. Previous wages plus this current wage. We see, yep, we're over the cap. As long as we see that we're over the cap, then we get rid of step 1. Don't even look at it anymore. Don't think about the 7,700. Don't think about any of that. Come down to step 2 and figure then how much do you have left to get to the cap. So if you're at 6,700 right now with your current wages and the cap starts at 7,000, you only have 300 left that's taxable and then nothing because you're over the $7,000 mark. So if I take 300 times 0.006 or 0.6%, I get $1.80. $300, that's how much was left, times 0.006. Now, when we look at step 1 again, and I see I have total wages of 7,700. For SUTA, I haven't hit the cap, so I don't even have to go to step 2. Remember, the cap is 9,500. So I haven't hit 9,500 yet, so all $1,000 is taxable at the given SUTA rate, which I tell us in the problem was 4%. So we're going to take 1,000 times 4%. Then all I'm going to do is add up these 4 taxes. That is how I get my debit, my payroll tax expense. So I put in the $1,450 for Medicare. We come down to my FUTA and SUTA, $1.80 and the 40 bucks. And then I come back over to my expenses, and just below my wage expense, I put in my payroll tax expense amount, the $118.30 that I just did in my journal. Now, the final step that I want us to know how to do right away is when it comes time to pay our bill to the IRS. We pay certain taxes at certain times, and we'll get into that later on in the semester. But for right now, let's assume that I'm ready to pay off my federal withholdings, Social Security, and Medicare. I'm ready to pay these. So I need to look back to my T account at this point. I got to see how much do I owe to these 3 taxes. Okay, so let's do them in order. Let's go back up to Social Security. If I add up the 62 and the 62, that's $124 that I owe. So when I'm ready to pay it, I'm going to come over here and debit $124. That leaves me a balance that I owe nothing. And then therefore, that's what I'm going to do in my first journal entry. I'm going to debit my Social Security payable account for the $124. Now, we're going to do that for the next one, the Medicare tax. We're going to add up our 14.5 and then the employer's 14.5. That comes out to be $29. I'm going to pay it off so I no longer owe it. So that's debiting $29. And we put it here in our journal. Finally, I'm paying off my federal income tax. We owed 50 bucks. I'm going to pay that here now, so I'm going to pay the 50, so get rid of it. Balance of 0. My federal withholding payable account has now been debited. I'm going to then write a check for these 3 dollar amounts. And I'm going to credit my cash, since I wrote the check, for $203, paying my Social Security, my Medicare, and my federal withholding bill. And then I come over to my cash T account and credit it for $203 to show I don't have that money anymore. I had to pay the government. At this point, now let's see how much you've actually retained. I want you, after we're going to talk through this one for just a couple minutes, and then I want you to pause the video and then complete it, and let's see if your final answers come in and match with what mine have. So with this example, it's very similar to the previous one. We have the same pay date, March 15th. Previous earnings are slightly less. The person makes slightly more this time though. And then I give you the rates that I have to give you. You're expected to know the rest. And then finally, instead of just the $5,000 for cash and common stock that I told us the first time, now we have a few more opening balances. And these, especially, we're going to pay off when it's time to make our payment to the government. So when you start, you're going to have $3,000 instead of $5,000. But then you're also going to have, so I have it started here, just a few of the accounts to show, $3,000, and then you're going to have your first entry is $70 in your Social Security payable, because that's your opening balance. You're going to have the same for the Medicare and the federal income tax. You're going to have opening balances. And then to round it all out, my capital account is at $28.40. So now what I want you to do is do the two journal entries, the employee and the employer. And then finally pay the bill for all the federal income tax, Social Security, and Medicare that show on your T accounts. The total, the amount there. So go ahead and at this point, pause. And then once you think you have your final answers, go ahead and unpause it. I'm going to wait a few seconds and then we're going to go through the answers. Okay, so if you are at this point now, you should have completed the practice entry, and let's see how you did. The first part of the answer should have looked like this. Let's go through them in a few steps. Your debit to how much the employee earned this payroll, $1,500. And then the first two items, we nowhere near hit the cap for the Social Security. So the full $1,500 taxed at 6.2%. Medicare 1.45. I told us the federal income tax was 6%. I expect you to remember the Indiana state, and then I told you the county of 1.5%. And then finally, we take our wage expense, subtract out all of the taxes, and we figure out how much do we owe the employee. And so you should have also at this point had these already in your general ledger. So the wage expense of $1,500, and then our first Social Security tax, $93, and then the Medicare, federal income tax was $90, and $48.45 for the state, and $22.50 for the county. When you add them all up, how much you paid your employee in cash coming out of the account, $1,224.30. Now for part two, the second journal entry. Remember, there's always two journal entries per pay period. The first one here would have been unknown. Initially, we would have had question marks here. We didn't know how much we owe until we do these four items. Social Security and Medicare remain the same. FUTA, well, this one we did go over the cap. So remember the two steps. Previous earnings plus our current wages. That takes us to $7,600. That's over the cap. So we go down to step two, $7,000 minus the cap amount minus how much we've made. Tells me there's $900 left to be taxed. So $900 at 6.6% instead of the full $1,500. Gives me $540. And then the SUTA, I tell us in the problem, is 2.5%. This amount is not over the SUTA cap of $9,500. So no cap hit there. Add these all up, and we do get the $157.65. Finally, you come down here to the pay your federal income tax, Social Security, and Medicare taxes. With these, we're going to simply look at our T accounts now. Social Security, when I add up these three amounts, the beginning amount that I had told us, plus the two journal entries that I just did, it comes out to $256 that I owe. So that needs to be my first debit, the $256. Medicare, we do the same thing. We add up the three amounts that we have due. They add up to $73.50. Federal income tax, I only had the two items, my beginning and then the employee, what they had taken out of their check, $150. When we add all three of these together, we are writing a check to the IRS for $479.50. and then I would want to show that in my cash T account.